Hey guys, thanks for joining me today. My name's Jason Fieber. I'm the founder of Dividend Mantra. I'm the founder and publisher of Mr. Free at 33, and of course, I write the undervalued dividend growth stock of the week articles for Daily Trade Alert. And I've been working with the guys over at Daily Trade Alert now for a few years. They're great. They're just really wonderful to work with, and it's a collaborative effort between us. So we, bounce ideas off of each other and have come up with some really wonderful concepts for you readers and now viewers over the years. And one of the ideas that they came up with was to do a video series with what we're planning on doing today. Is this is the initial video we're going to be doing, and what it's designed to do is it's designed to complement the undervalued dividend growth stock of the week articles. So what I'm going to do today is I'm going to go over all of the numbers that I use and that I come up with for the articles, so you readers can kind of follow along and see where all these numbers come from. That way, if you're new to investing or you're new to the series, or even if you're an experienced investor, when I'm talking about top line growth or bottom line growth, or the dividend metrics or some of the other fundamentals like the balance sheet, when you start seeing these terms and these numbers, if any of them are overwhelming or maybe you're not familiar with them, or you're kind of wondering where I get all these numbers from, I'm going to share all that today, and I think it'll add a lot of value and a lot of perspective for you readers. And that way, when you're reading these articles in the future, or even if you access the archive, there's probably a couple hundred articles now that I've written for Daily Trade Alert for the undervalued series. If you read those articles and you watch this video, you'll be able to follow along very easily and say, okay, I see where this number comes from. Okay, I see where its conclusion is here, and everything else. Keeping in mind that when I write the undervalued dividend growth stock of the week articles, it's largely a high level look at a stock, and it's mostly focusing on the fundamentals, the quantitative analysis, if you will. And so what I'm looking at is I'm looking at hard numbers. I'm looking at dividend metrics. I'm looking at revenue and EPS growth. I'm looking at long-term debt and things like that. And the reason why I focus on the fundamentals of a business is because we're dealing with quantitative hard numbers. These are numbers that really can't be argued with. I'm not massaging anything. I'm simply looking at financial statements and distilling all that information down into actionable and readable information for you readers out there. Whereas qualitative analysis is looking at things like brand power and distribution networks and other competitive advantages of a business. And the reason why I don't focus too much on that with the articles is because it's highly subjective. I could take a look at a company and I could say it's brand power is X, or its pricing power is X, and another investor could come by and take a look at that same business and view all that as being worth much more or much less. So there's a lot more wiggle room when you're looking at qualitative analysis. Quantitative analysis is there's really not much margin for error there. I mean, you're using hard numbers to formulate a conclusion, and so I think it's far more actionable and it's far easier to follow along, and there's far less to really kind of disagree with. So it's not really trying to write an article that's something where nobody can disagree with my conclusion or anything like that, but instead it's just designed to be something very easy to follow along. We're using simple numbers that are very easy to go back, as we'll do in this video, to go back and show you where everything's coming from and everything else. Whereas qualitative analysis is just really up to the individual investor to formulate and come to conclusions and everything else. And that's where as an individual investor, that's where you come into play. When you read these articles, you can take a look and see the quantitative side of a business, and then from there it'd be up to you to say, okay, well, what are the risks involved? What are the competitive advantages? How do I feel about this business? What is this company's story? Do I understand the business model and everything else like that? So today what I'm going to be doing is I'm going to be looking at Coca-Cola. And the reason why I chose Coca-Cola for today's video is because it's a widely known, widely held dividend growth stock. It's a business where even if you're new to investing or you're not an investor at all, you're probably pretty familiar with the business model. You've probably enjoyed one of their beverages very recently, or maybe even today, or maybe you're drinking one while you're watching this video, because they own 500 or so non-alcoholic brands around the world. So if you're drinking bottled water or juice or a carbonated beverage or an energy drink, the odds are pretty good that Coca-Cola has something to do with that. So I think it's a great stock to use as kind of a template, if you will, for the articles and for this video. This video is going to be a reference point, an evergreen video that we're gonna have up on the site. And then what we plan on doing as again, to further complement the articles, the guys over at Daily Trade Alert want me to do one video per month focusing on one of the undervalued dividend growth stock of the week from the prior month. So let's say, in the month of August, I write about 4 different undervalued stocks, and then I choose one of them. Let's say it's Amgen or Cisco or whatever it may be. I then create a video following along the article step by step, showing where all the numbers came about, where I came up with my conclusion, everything else. And that way it's very easy for you readers to follow along. I think it's going to add more value and more perspective to the article. So I think it's a great idea, and that's why I decided to set aside some time today to put everything together for you readers and go over everything. So what I've got a couple different links pulled up, and these are links I use. These are reports that I use for my articles to create all, to distill all the information down and create the articles and everything else. And that's why I think this will be a template going forward. So again, I have Coca-Cola pulled up, and when you read the articles, the first thing that you'll see after I kind of go through the introduction is the dividend metrics. So I go through, how many consecutive years a particular company has increased its dividend. I look at a 10-year dividend growth rate. I'll look at a payout ratio, and I'll look at the yield. And so Coca-Cola, again, it's a prototypical dividend growth stock. It's increased its dividend for 55 consecutive years, which is, one of the longest streaks in the world. The 10-year dividend growth rate, upper single digits here, well in excess of inflation, obviously, which is just fantastic. So right away, these two numbers here, 8.5% 10-year dividend growth rate and 55 years of consecutive dividend growth. That's why it's a widely held and widely known dividend growth stock, right? And it's an easy to understand business, non-alcoholic beverages, Coca-Cola, Dasani water, Simply Orange, so on and so forth. Very, well-known brands, very easy to understand business model. And then another thing I kind of look at in the articles and I talk a little bit about is either acceleration or deceleration of dividend growth. And so what I do is, again, I look at the 10-year dividend growth rate first, and that's because I consider 10 years as a pretty good proxy for the long haul, at least the recent long term. When you start looking at growth of a business and dividend growth and earnings growth and revenue growth, you can certainly go back 20 or 30 years and try to start pulling annual reports from, the 80s if you want. But, what a company was doing maybe in 1976 might not have a lot to do with what it's doing in 2017. So again, I look at 10 years. I consider that a pretty good proxy for the long term. You're certainly more than welcome if you want to do even deeper or further analysis with a business to go even further than that. But I consider 10 years a very good starting point when you're starting to formulate baseline expectations going forward. So again, that deceleration or acceleration, you see that play out right here. The most recent increase was a little under 6%, and you see the numbers drop here: 5-year 8.3, 3-year 7.7, 1-year 6.1, and you see that deceleration really playing out because the payout ratio is so high. Coca-Cola is essentially sending all of its earnings out to shareholders in the form of a dividend. Their payout ratio is essentially basically 100% right now. And so that leaves very little room for future dividend increases from here. And I think I'm a shareholder of Coca-Cola. I've owned the stock, since the first time I bought Coke was the summer of 2010. I started investing in the summer of 2010. I started dividend growth investing in the summer of 2010, so it's been about 7 years now. And it was one of the first stocks I bought. I think along with Johnson & Johnson and ExxonMobil, there were a few stocks in there that were some of my early purchases, some very, very early on investments. And back then, Coke was really just a more appealing business overall, and we'll go over some of the fundamentals and we'll show kind of what's happened to the business, recently. But the payout ratio when I first invested was a lot lower than it is right now. I think it was maybe, I want to say maybe 60 or 70%, which was still high, still elevated, but it's a very stable business. It's again easy to understand business model, and I thought the growth wouldn't be that volatile. But what's happened is that the company hasn't really grown, but the dividend continues to increase, and so that's created a situation that's really unattractive, because that payout ratio being that high, 100%, leaves very little. It leaves really no room for the dividend to continue growing. And not only that, but the payout ratio, kind of going, doing some background here, I consider a payout ratio of 50% to be kind of perfect, if you will, or a pretty harmonious balance between returning cash to shareholders and retaining earnings to continue to grow the business, either through reinvestment or M&A or what have you. So When you're sending out half of the earnings in the form of dividends, that basically means the shareholders, again, keeping in mind that shareholders are the collective owners of any publicly traded company. So when you own stock in a company, you really own a portion of that business. It may be really small. I own very little, tiny slivers of these businesses, but you do own a slice of it nonetheless. And so when you're collecting a dividend, it's your rightful share of the company's profit. I mean, if I owned a business in its entirety, if I owned, Jason's Pizza Shop down the road, then I would expect a portion of its profit to come back to me, once a week or once a month or what have you. I would expect a paycheck, and if I'm risking my cash, I want some money on the regular. And certainly the business should increase in value over time naturally. I mean, just as a business, sells more product or more service or what have you, the business will become worth more. It's not, mutually exclusive. It's not either or. You don't either get dividends or a business becomes worth more. Really, it should be both. But again, I expect a paycheck if I'm going to invest in a business and I own a piece of it. Then I want my rightful share of its profit. So when you have a payout ratio of 50%, that's a really nice balance between, hey, we're going to keep some of this cash to reinvest in the business, and we're also going to send shareholders their rightful share of the profit. And in addition, that kind of limits, the amount of trouble management can get into. If a company's keeping 80% of its profit or 90 or even 100% if it doesn't pay dividend at all, then there's a lot of wiggle room there for management to kind of maybe blow some of that money. It's kind of like you'll hear about lottery winners all of a sudden come into a lot of cash and then the money's gone after a few years or whatever. If you have more money than you need, then you create an atmosphere for the potential for waste. And so we want to try to limit that. And again, a dividend is just, it's your rightful share of profit. So it makes sense to collect it, but it makes sense to collect it in a prudent way. And Coca-Cola's become very imprudent here at 100% payout ratio. So overall, the dividend metrics here for Coke are strong because you've got the 50 plus years of consecutive dividend growth. You've got a great yield. This yield of 3.4% is well above the broader market. That's well in excess of the broader market. That's more than 100 basis points over what the S&P 500 pays right now. And you've got a recent dividend increase of over almost 6%, which is well in excess of inflation, which is fantastic. But that payout ratio is a major red flag. I would expect Coca-Cola's dividend, if they're going to continue growing, and it's going to be in the very low single digits going forward, unless the company starts miraculously growing much faster, or they just decide to take on more debt to continue to fund that dividend. I mean, they certainly have some levers to pull, but it's limited with that payout ratio being so high, and especially if you want to think about Coca-Cola reinvesting back into the business, they're limited for that as well. So that's some of the things that I write about when I write these articles. I kind of take these numbers and kind of walk you through them and say, hey, this is the yield, this is the dividend growth, but this is maybe where we're going in the future because of these numbers. So I'd say, hey, look, the payout ratio is very high for Coke, so temper your expectations for future dividend growth. I mean, Coca-Cola, if this were any other company, if it weren't Coca-Cola, if it weren't 55 years of consecutive dividend growth, if it weren't selling carbonated beverages and bottled water, I'd be very concerned about a dividend cut, frankly. But, I know that Coca-Cola is steadfastly committed to its dividend. The wherewithal is very high there. So, they get kind of a pass on that a little bit. But, I think, I'm kind of keeping Coke on a shorter leash than I otherwise would, because of where they're at there. So, the next section in every article, the information I go over after the dividend would be the growth. And again, I consider 10 years as a good proxy, so I look at 10-year revenue and 10-year earnings per share growth. And then I compare that to a near-term forecast using S&P Capital IQ's forecast for 3-year future expected or forecast earnings per share growth. So I look at what a company's done over the last 10 years in terms of revenue, in terms of earnings per share, and then I compare that to what we think they might do over the next few years. Keeping in mind that forecasting what a company's going to be doing next month, let alone 3 years from now, is very difficult. So you take that with a grain of salt, and you try to take the last 10 years along with what we think they might do over the next few years, and you kind of mesh those numbers together. And again, that starts to form a baseline for future expectations for what you think they may do going forward. So I've got two annual reports or two 10Ks pulled up here for Coca-Cola. I've got the 2007 and I've got the 2016 10Ks pulled up, which is 10 years of information, which is what I use for the articles. I pull the 10Ks for every business, and I start to look at what they've done in terms of basically the fundamentals across the board, again starting with revenue and earnings per share growth. And we can kind of see what they've done with revenue real easily here. You've got operating revenue of 28 point almost 9 billion in 2007. In 2016, Coke sold almost 42 billion worth of product. So pretty solid growth. I mean, this is a mature company, and they obviously have some headwinds there, with especially in developed countries where people are not purchasing carbonated beverages as much as they used to. So there's some headwinds there to consider. But taking a look at the growth, I got a compound annual growth rate calculator. I use Investopedia for that, and we just put in basically the two numbers. You got 28,857. And then you've got 41,863, right? And we're using 9 periods because although it's 10 years of data, the first year isn't a growth year. That's your starting point. So it's 9 periods. So we've got revenue growth of just over 4% over the last 10 years, which is okay. I mean, it's not fantastic. It's not terrible. It's a mature company that has some issues with some of their products maybe being under fire. There's a lot of sugary beverage taxes being passed in major cities across the United States right now, and developed countries in general are facing issues with obesity, and there's some pushback on sugar in general. And so some of Coca-Cola's, especially their namesake beverage, Coca-Cola is facing some issues there in terms of pricing power and volume and pressure on sales and everything else. So it's something to keep in mind going forward. But over the last 10 years, I've done 4% compound annual growth rate in revenue, which if you want to look out over the next 10 years, it might even be difficult for them to match that, because 10 years ago I think the headwinds weren't as strong as they are now for growth. So looking out over the next 10 years, factoring out some type of M&A or some type something happening with the business, which again is limited because of that payout ratio being so high, might be a little bit more difficult going forward. So just something to be mindful of. So that's the first thing I look at. I look at revenue growth over the last 10 years, and then I look at earnings per share growth. Earnings per share growth is diluted net income per share. You can see the starting number here, 2.57. And then you see 2016, you see $1.49. And you might say to yourself, whoa, what happened here? Earnings per share fell significantly. Well, not really. What happened is Coke did a stock split, and you can kind of key into that when you see the average shares outstanding, 23.31, 43.67. You can see right off the top of your head that they probably doubled. Another good way to check a stock split is I use Google Finance for my stock quotes, and they show stock splits right here in the timeline. So you see a 2-for-1 stock split there in 2012. So that right away tells you that the old numbers have to be split in half. And another thing I want to kind of pop into here real quick is Morningstar. I use Morningstar a lot of times too. I find them to be a really good third-party aggregation service. They aggregate information pretty accurately. If I had to put a number on Morningstar, I'd probably say that they're accurate about maybe 90% plus the time. So when you're looking at all these numbers, when you pull up 10 years worth of information here, these numbers are again accurate. I'd say 9 out of 10 times, or maybe even better than that. I've seen a few cases where the numbers are kind of a little off, a little wick-whack a little bit, but other than that, like the revenue here, you can see it. We just pulled that up. 28,857, 41,863, 28,857, 41,863. Okay. And the earnings per share, the cool thing about Morningstar is they factor in stock splits, so they've already got the numbers accounted for in that. So you can see right here 128, 149. So if you go over here, earnings per share growth over the last 10 years, if you look at compound annual growth, it's 1.7%, so a little under 2%. Generally, when you see a disconnect between revenue growth and earnings per share growth, it can be explained through a number of different ways. Either if earnings per share growth is significantly higher than revenue growth, then you probably have some margin expansion and/or significant share buybacks, reducing the numbers of the number of shares outstanding. And when a company buys back stock, if you're looking at profit in terms of like a profit pie, well, buying back stock reduces the number of slices of pie. And so each shareholder then owns a little more profit in the company on a per share basis. So when you buy back stock, it's kind of accretive to earnings per share growth because you're reducing the number of shares outstanding. So it changes the end number there. With Coke, you actually see slower earnings per share growth relative to revenue growth. And the reason why, if we pop back in here, you can see the margins compressing here. Gross margin, you see compression there, 64 to about 61. And I use net margin because net margin is after everything's all said and done. After everything's factored into revenue and earnings per share, that's actually how much profit dropped down to the bottom line from revenue. And you see the net margin compressing too, which again can be explained through those headwinds I just mentioned earlier. They've also got some issues with currency exchange and whatnot affecting GAAP earnings per share. But overall, Coke is under pressure. I mean, some of their headline beverages are having some issues in terms of volume growth and pricing growth and things like that. So it shouldn't be surprising to see some margin compression there. Profitability compression in general. You see return on equity here dropping, ROIC dropping. So not terribly surprising. Nonetheless, we see where the growth is at. So we've got revenue growth a little over 4%. We've got earnings per share growth a little under 2%. So it's a mature business, not growing, probably what we'd like to see. I mean, even with a mature business, if it's a good business, I look for, EPS growth. If you're looking at compound annual growth, I like to see at least mid-single digits, 5%, 6%, in that range. Coke is well below that. So, disappointing. And obviously now we see why the payout ratio is so high. When you have a dividend growth rate over the last 10 years, they're over 8%, as we saw earlier. Earnings per share growth is under 2 over that same time frame. So there's a significant gap between the two. The dividend is just growing much faster than the underlying earnings. So at some point that has to reconcile, and there's going to be a reckoning. So I would expect, again, Coke's dividend raises over, going forward are going to be, very small. They're going to have to be, because they just don't have any more flexibility to continue growing the dividend much faster than earnings. So just something to keep in mind there. And especially when we start to form baseline expectations and we start to value the business, these are important numbers to kind of keep in your mind. Like, okay, well, Coke's growing, a couple percentage points a year. The dividend is obviously slowing down. The payout ratio is very high. So, when you start to say, okay, well, what do I think the dividend is going to grow at going forward? You have to kind of keep all these numbers in the back of your head, when it comes time to actually, value the business and extrapolate these numbers out going forward, way out into the future. So anyways, we've got revenue, we've got earnings per share growth. The next thing I look at, again, so we pulled up the last 10 years of revenue and earnings per share growth. I then compare that to a kind of go forward number, if you will. And I use S&P Capital IQ for that. And you can see Coca-Cola here, S&P Capital IQ, they're putting their 3-year projected earnings per share compound annual growth rate at 7%. So S&P Capital IQ obviously believes that there's going to be some acceleration there. I don't know. I mean, again, we're looking at under 2% over the last 10 years. That would be a significant acceleration going forward. So, I would probably take that with a grain of salt. And they include their rationale and some of their highlights, and they kind of form the basis for their opinion in this area. But nonetheless, regardless, I would feel a little uneasy thinking that, just automatically assuming that Coke's going to be accelerating their growth by that much going forward over the next 3 years. That might be tough. So, but nonetheless, again, we would say, okay, well, they've grown at almost 2% over the last 10 years. We think that there's gonna be some acceleration there, and you maybe meet in the middle somewhere and say, okay, well, I'd be happy with 4.5% EPS growth over the next 3 years, which would still be a doubling of what they've done over the last 10. So. I wouldn't maybe go up to 7 there, but I'd maybe split the difference when I'm doing an analysis on this. So that's what I'm looking at in terms of underlying growth. So we've gone over the dividend metrics, we've gone over EPS and revenue growth. The next thing that I start to look at is the balance sheet, and so we just scroll down here. Coke's got their balance sheets, very easy to read, which again makes for a very nice stock to use as a template for this video series here. The first number I look at is long-term debt to equity ratio, which is kind of a bellwether metric for a company's balance sheet. You're basically just taking long-term debt and dividing by shareholder equity. Shareholder equity is essentially the net worth of a business. So it's assets minus liabilities. If you were to take your own personal net worth That would be your shareholder equity, with you being the only shareholder in your own personal business. If you're the CEO of your own company, that's what shareholder equity is. With businesses, it's a bit more complicated though, because equity can be positively or negatively affected by a number of factors. And one of the biggest that I tend to see is this treasury stock, which is stock that's been bought back that's still on the books. And you can see here it's grown quite a bit for Coke because they've been buying back stock over the last 10 years. They've been buying back stock for really a long time, but you see the treasury stock's grown. It's 23 bill, now it's almost 48 bill. So that's negatively affecting shareholder equity. And you see shareholder equity over here at 21, 2007, 23. So it's barely grown, even though the business is obviously selling more product, selling a lot. The revenue's a lot higher. The earnings per share, although it hasn't grown that much, it is still higher. So that's obviously negatively affecting that. And that's because we see, as we saw earlier, the outstanding share count, which we can pull up Morningstar. They've adjusted for the split count. The shares here, you can see they've gone down, 4.6 billion to 4.3 billion. So they have been buying back stock, but the margin compression has been somewhat significant, and so that's kind of offset that in terms of earnings per share growth. But taking a look at the long-term debt to equity, I forgot to pull up my calculator here, so let me pull it up here real quick. We basically just take the two numbers. So we take long-term debt, and I'm using, when I look at the balance sheet, when I'm doing these articles, I'm obviously using the most recent balance sheet, because a balance sheet from 10 years ago isn't really relevant to what a company is doing today. It doesn't really tell you very much. Actually, it's basically just unusable information. So long-term debt, we've got 29,684 right here, right? And we divide that by shareholder equity, which is right here, 23,062. So long-term debt to equity ratio for Coke is 1.29. And again, third-party aggregators like Morningstar, even Google Finance, tends to be pretty accurate. Let's see what they have their long-term debt to equity ratio, 128.71. Yeah, exactly. You see, guys, 128.71, 128.71. It's the same exact number. So I always recommend any investor out there, if you're looking at a stock or a business, you should always be pulling up 10Ks and 10Qs and press releases and get very familiar with the business. If you're going to, invest thousands of dollars in a business, you should become very familiar with what it's doing. You should research heavily. I listened to a speech by Peter Lynch, who ran Fidelity's Magellan Fund for a long time. He's one of the most successful investors of all time. And I was listening to a speech by him he made back in, I think, the late 90s. And he was talking about how people will do all kinds of research on like appliances. They'll read consumer reports. They'll ask their neighbor, "Oh, what do you think about, such and such refrigerators or ovens?" They'll ask their parents, "Oh, what do you think, who makes your stove? Who makes your refrigerator?" So if they're looking for new appliances, they'll go through, they'll jump through all these hoops and, leap over hurdles and, all the rigmarole involved with the research involving appliances. But then when it comes to stock, they'll just overhear a stock tip on the bus or something and buy stock. So obviously he's maybe exaggerating a little bit, but you should be doing plenty of research on any business. If you're just pulling up Google Finance and you just buy stock based on what you see real quick here, that's not a good idea. So I do like to compare the numbers and show that usually the accuracy is pretty good, but it isn't always. I've seen a lot of reports out there, even by Morningstar, and where the numbers don't really match up very well. And if you're using incorrect information to form an opinion in your mind about a business, you're going about it the wrong way, because you might not be investing in what you think you're investing in. So you should always be pulling up the actual financial reports. But if you compare the two and kind of look, and it's sometimes a good idea to say, okay, well, I came up with this number. What did they come up with? And see if there's maybe a difference. And if there is, then that maybe gives you a reason to go back and double check the numbers, or make sure that you're looking at the right stuff. So we've got the long-term debt to equity ratio here. Again, I consider long-term debt to equity ratio below 1 is good and above 1 is bad. That's just generally speaking. It depends on the industry. No business is operating in a vacuum. So, but generally speaking, 1's kind of my line in the sand. If a business has a long-term debt to equity ratio significantly over 1, I start to become concerned. Significantly below 1, I feel pretty good about that. And if you go in and educate yourself about investing, you'll kind of see that number pop up a lot. A lot of investors consider 1 as a pretty good, a line in the sand for that. But, the other things to consider when you're looking at a balance sheet is, when you have long-term debt, how much cash does a company have? So when we look at their most recent 10K here for Coke, they've got a little under 30 billion in long-term debt, but they got total cash at almost over 18 billion. So total cash on the balance sheet matches up pretty well against long-term debt. So when you look at something like that, if a company has 40 billion in long-term debt, you start to say, whoa, it's a lot of long-term debt, but they have 40 billion in cash. Then at that point, it's probably not something to be overly concerned about. Moreover, as I noted earlier, treasury stock can impact that equity, negatively skewing the long-term debt to equity ratio, because if the equity is much, much lower, then it makes it look like the debt to equity ratio is higher than it otherwise would be. And Coca-Cola's numbers skewed downward by the treasury stock. So, just some things to keep in mind. That said, Coca-Cola's balance sheet has deteriorated somewhat over the last decade. We see that the long-term debt is almost 30 billion. Back in 2007, long-term debt was 3. So, geez, I mean, it's up by like tenfold, right? Total cash back then, cash and equivalents over here, we're looking at what, 4? Cash certainly isn't up tenfold. I mean, otherwise it'd be 40 billion. And the business hasn't grown that much. I mean, the Coca-Cola has not grown by 10 times, as we just saw. So for long-term debt to explode by 10 times over a decade, that's pretty strong. That's a pretty big move. So again, when I first invested in Coke back in 2010, the balance sheet was better, the growth looked better, the payout ratio was lower. Everything about the business looked more appealing than it does now. So what we have now is we have a very high payout ratio. We have a balance sheet that isn't terrible, but it's certainly less flexible than it was a decade ago. So Coke has obviously pulled a lever. They've taken advantage of low interest rates. They've put some long-term debt on the books. They bought back some stock, paid a dividend. And that's not something uncommon. A lot of companies, especially mature companies, have taken advantage of low interest rates over the last 10 years. And they put some long-term debt on the books, and they bought back stock, which, equity is usually more expensive than debt, especially when interest rates are low. They've been paying out that growing dividend and everything else. So, you can look at that a couple different ways, but overall, it does limit the amount of flexibility that a company has moving forward if it's taken on a lot of debt. And interest rates are going to rise at some point here. They're already starting to a little bit. And so that makes that debt a little more expensive going forward. And again, further limits, what a company can do. So the long-term debt to equity ratio is the first number I look at. If you'll notice in the articles, I also take a look at what's called the interest coverage ratio. And what that is basically EBIT divided by interest expense. So you're trying to figure out, how readily a company or how easily a company can cover its interest expense. And so it's very easy to come up with that number. You basically look at earnings before interest and taxes. So you've got income before taxes and interest expense right here. So you just factor that 733 million out to get EBIT. So you got 8136, you factor out the 733 million. So you get EBIT of almost 8.9 billion, right? 8869. And then you divide that by the interest expense, which is 733 million. So you get an interest coverage ratio of just over 12, approximately 12. So Coke's covering their interest expense 12 times over with earnings before income taxes and interest expense, which is pretty good. I mean, anytime you got an interest coverage ratio of double digits, that's pretty solid. If you start to get an interest coverage ratio down in the very low single digits, like a 1 or a 2 or a 3, that can become problematic unless you have a very, very stable business with highly visible revenue and earnings, like a utility company. They typically have very low interest coverage ratios. But outside that, you're gonna want to be careful with an interest coverage ratio that low, because it basically just says, hey, we're only able to cover our interest expense 1 or 2 or 3 times over. So if our EBIT drops or interest expenses rise, if one of the two happen especially sharply, then that creates an issue where they can kind of be putting themselves into a death spiral there, where they all of a sudden have to come up with ways to cover their interest expense. It limits what they can do on the equity side and everything else. So, or they have to maybe raise cash by diluting shareholders, and that further creates a problem. So, again, I consider double digits, 10 and above, as good, as and the higher the better, for the most part, all else equal. But low single digits is something you might want to stay away from. And we can see here Morningstar, if we pull them up, they usually track that, and you can see here 12.10, guys. 12.09, which is rounded up, 12.1. So very accurate, but we can see a deterioration here. Again, I already showed you the deterioration in the balance sheet, but you see that come up in the interest coverage ratio too. It was, about 20 or over a decade ago, and now it's in the low double digits. And actually for the trailing 12 months here, it's almost breaking below 10. So Coke continues to deteriorate their balance sheet, and um, again, it's not problematic. I'm not saying that, but I am saying that it's become worse than it was. And if it continues in this direction, it could become problematic for the company, especially when keeping in mind that payout ratio is so high. Dividend growth going forward is probably going to be limited. If they want to continue growing the business, they're going to have to be more flexible. So they continue to pull levers, and at some point you kind of run out of levers, and that might be a situation they're going to run into here in the next 5 or 10 years if they keep at this pace. So Coke has a new CEO, and he's trying to streamline the business, cut costs, and do some other things. So, and obviously there's some repatriation tax questions on the table right now. I'm taping this video here in May of 2017. So, this video is up in a few years. I don't know what will happen with all that, but, there's some cash overseas for Coke, so that can, create some additional flexibility. So there's some levers still, but again, Coke is becoming less high quality by the year. So just something to keep in mind there. So we looked at the balance sheet. Those are the key numbers I look at: long-term debt to equity ratio, interest coverage ratio, keeping in mind, how much cash does the business have on hand? Is the equity being negatively or positively skewed? And how does that affect the long-term debt to equity ratio and what have you? And then the next section I look at in these articles is profitability, which is net margin return on equity. And Morningstar, again, they're pretty accurate with this. You see net margin here, 20%, dropping down to 16 here most recently. Under 16, return on equity was up near 30%, 26% down here. The source I use in the articles, I look at 5-year net margin and 5-year return on equity, because I consider that a pretty good recent number as an average. So I'm looking at average 5-year numbers for these two profitability metrics, and I use S&P Capital IQ for that. And you see here net margin 17% over the last 5 years for Coke, return on equity 25.91%. And net margin, for instance, is a very easy number to generate on your own if you're not familiar with it. All these numbers are pretty easy, really. Net margin is just net profit divided by net revenue. So you have consolidated net income 6550. I'm sorry, I want net income attributable to shareholders, so 6527 divided by 41863, which is revenue. So you get a net margin of 15.59 here, right? 15.6%. And you see here, guys, right here, Morningstar has a pretty accurate 15.59. So again, if you're in a hurry, or if you're just kind of quickly looking at stock to get just kind of an idea in your head as far as what they're doing, or you're comparing it from one stock to another, Morningstar is pretty good for that. And again, nothing exists in a vacuum. So when you're looking at some of these numbers, it makes sense to compare it to other stocks or other companies in the same industry, because comparing like Visa to Walmart, if you're looking at margins, for instance, is going to it's not applicable, because Walmart has very low margins because it's in retail, and so it has to do a lot of volume to make a good chunk of profit, whereas Visa can scale up almost indefinitely. So very different businesses. And when you look at the industry, Coke actually fares pretty well here. I don't know if I'd say Coke has a direct peer, because they're a global beverage company, and they really don't have a peer. I mean, Dr. Pepper Snapple is pretty much just in the United States, and they're a pretty small company. I mean, Coke's a $186 billion market cap company. Dr. Pepper Snapple, $16 billion. Pepsi is probably your closest competitor, but they have a sizable snack business, with Frito-Lay. So, I don't know if I'd really even compare the two, but nonetheless, you can see that they fare pretty well here. Net margins, they're beating out DPS and PEP there. Return on equity, maybe not faring quite as well, but keeping in mind that Coke, their balance sheet actually looks a little better than Pepsi and Dr. Pepper Snapple. So just kind of looking at these key ratios real quick, the long-term debt to equity. So those are the main the main areas I'm looking at. I'm looking at fundamentals. I'm looking at the dividend metrics. I want to see a good payout ratio, a good yield. I want to see that the dividend can probably continue to grow. I want to see good revenue growth, good earnings per share growth. I'm comparing what they've done over the last 10 years as a proxy for the long haul. I'm comparing that to a forecast for near-term growth. I'm looking at the balance sheet. I want to see a good balance sheet, which means that there's some flexibility for the business if they see an attractive M&A candidate. If they maybe want to buy back stock at an opportune time, if they need to reinvest back in the business, if they have some retained earnings and a good balance sheet, that just creates more flexibility. It lowers borrowing costs when a balance sheet's very healthy. creating additional flexibility for shareholders and for the business. And then I want to see good profitability. All else equal, higher net margin is better than lower net margin. It's just profit margin. Net margin is basically, after all said and done, bottom line, what's your profit margin? All else equal, again, higher margin is better. With businesses that are in, retail or like middlemen businesses that maybe are heavy in distribution, you'll typically see lower margins. And so they have to do a lot of business. They have to do a high volume of revenue in order to get, a decent amount of profit out of that. So, again, all else equal, you'd rather squeeze 20 cents out of a dollar than a nickel. So, and when you see some compression there, that's something that, is kind of a negative against a business. And Coke's margin, their net margin has compressed quite a bit. So, and return on equity is basically just, profit on shareholder net worth, on equity, which, is kind of a metric that has long been considered as a key profitability number. I don't really place a lot of importance on ROE. I think margin is far more important because it just tells me, in terms of profit, how much money is dropping down to the bottom line from revenue. After cost of goods sold, after everything's all said and done, what are you left with from your revenue? And I think that's a far more meaningful profitability metric. And then the last number I get into is valuation, guys. And valuation is investing's part art, part science. The science is the objective side of the investing, the quantitative side. The qualitative side is where the art comes in, and that's also where valuation fits in. But when I do the valuation, I do a dividend discount model analysis, and I also compare where stock is at, where it's at today compared to where it's been over the last, say, 5 years or so, which tells me, is a stock expensive or cheap relative to what it's usually selling for. And when we look at the valuation tab on Morningstar here, we can see Coke's current metrics, the price to earnings ratio, price to book, price to sales, price to cash flow, against its 5-year averages, except for cash flow. Cash flow is a 3-year average. But you can see Coke's way up there. The price to earnings ratio right now is 30 times earnings. And I know that they have some adjustments to earnings, but that's very, very high for a business that really isn't growing very much. Price to book is also elevated. You see 8.2 PB ratio against a 5.9 5-year average, which arguably is expensive as it's in and of itself, because we're way above the broader market here, even on the 5-year average. But if you look at the current numbers, they're significantly above the S&P 500, and they're significantly above the 5-year average for the stock. So comparing apples to apples, really, Coke is actually slowing down and deteriorating, yet it's more expensive than its 5-year average back when the business was arguably more high quality. So that just tells me, this does not look like a very appealing stock on a valuation front. The only thing that it has going for it is that the yield's higher than its 5-year average, but that's only because the payout ratio is so high because the company's been growing its dividends so aggressively. So, sure, yeah, the yield's higher, but the payout ratio has been deteriorating, and future dividend growth is now sacrificed a little bit for that. So, not terribly good numbers on the valuation front. But I use a dividend discount model analysis. I have a spreadsheet, a custom spreadsheet that I use, but this Money Chimp DCF calculator, which you just substitute dividends for the DCF, is the same thing basically as my spreadsheet. You'll come up with the same exact numbers. When you're doing it, you're basically just using the next year of dividends. So Coke pays a 37-cent quarterly dividend, which you get right here, $1.48 a year. And then you're going to basically put in what you think the dividend can grow at moving forward. You can do a 2-stage model here, which you can say over the next 5 or 10 or 15 years or whatever, and then it's going to slow down to that thereafter. With a mature company like this, you wouldn't really use a 2-stage model. With a newer business or with a company that's only been growing its dividend for 4 or 5 years and has a very low payout ratio and a very high growth rate, you'd probably say, okay, for the next 5 or 10 years, I think it can grow its dividend at, say, 15%. But then thereafter it's going to drop down in the mid or high single digits. With Coke, it's very mature and it's really slowed down in terms of dividend growth. So you don't really need that 2-stage model because it's obviously not going to be accelerating anytime soon. So, I would say the dividend, guys, it's subjective. It's up to you. When I include the valuation in stocks, it's my opinion of what the dividend discount model should look like. But, you may come up with a different number. But nonetheless, if you want to give Coke the benefit of the doubt here, a big benefit of the doubt, you can maybe put in 5% here. But I think that's giving them, a huge benefit of the doubt there, just because Coke is Coke, and they, the wherewithal there, and the dedication of the dividend is very, very high, and they're not going to cut it. I don't expect them to cut it. I mean, if this were any other business, I'd say, man, I think the dividend might be cut here pretty soon. But with Coke, I'm going to give them the benefit of the doubt. But you can put in, what numbers you think here. If you think they're only going to grow the dividend at 3% indefinitely or 4% indefinitely or whatever it may be, that's the numbers you're going to put in the dividend discount model analysis. And then the discount rate, I use 10% on almost every stock out there because it's basically the rate of return I'm expecting from my investments. And I think there's a slight margin of safety with 10% because it exceeds the long-term compounded annual growth return, the return of the broader S&P 500, which is somewhere a little over 9% or something like that over the long haul. So I'm introducing a higher number than that, saying that I'm risking my capital, I'm spending some time with this research and everything else, so I expect a higher rate of return in exchange for that. In addition to my income, which is higher than the broader market too. So you're kind of getting your cake and eating it too, if you will. You get a little more yield than the broader market, and if you can get a higher rate of return overall, then you're kind of playing both sides of the coin there. And then you calculate it out. And if we use 5%, going forward, that gives you a fair value of 31.08. And obviously, compared to the current stock price of 43, Coke does not look appealing right now on evaluation. And that jibes with these numbers here being way over their recent historical average and way over the broader market. If you're looking for a 10% rate of return, you're not going to get it at Coke at 43 bucks. I don't see it happen. And I think I'm arguably being pretty aggressive here. And I think a dividend discount model analysis, when used correctly, has a triple margin of safety. The three margins of safety would be being conservative with your dividend growth rate, being aggressive with your discount rate, being over and above what the broader market has returned over the long haul, and then paying a price below what you come up with on your final conclusion. So if you're conservative here, and you're conservative here, and you're conservative here, then you should have a pretty strong case for a good margin of safety when you buy that stock. But I don't see how you have a margin of safety at all with Coke. You're arguably being aggressive here, and the stock price is way over 31.08. So if anything, Coke would more liken a sell than a buy to me here. It looks more like a stock you'd be looking at lightening up on, or maybe even selling, than a stock you'd be wanting to buy. But I view Coke as less of a, hey guys, this looks undervalued right now, because those videos will come later with the articles. I wanted to use Coke as more of a template, so you can see where the numbers are coming from and everything else. So that's where everything comes from. And then when I come up with my final number in the dividend discount model analysis, I compare that to S&P Capital IQ and Morningstar, and I average the three numbers out, which I think provides value and perspective for you readers. Because that way, if one number's way off, or if I'm high, or if I'm low, then it kind of says, okay, well, these are three different methodologies. You combine them together and you get a final number. And you can see here, S&P Capital IQ, they rank Coke as a buy, which, hey, that's just, it's one opinion, and you can take it for what it's worth, as well as you can take mine for what it's worth. They rank Coke as being worth 36 bucks, so it's interesting that they have the stock overvalued by over 16%, yet they view it as a buy. I really can't explain that. Nonetheless, they do have the stock as overvalued. They have it worth 36 bucks. Morningstar has it worth 46. So, if we were to average these three numbers out, like if we were doing an article, I'd take 46. I'd take 36. And I take 31.08, and I divide it by 3. I'd come up with a stock worth, we call it 38 bucks. I think even that is really being aggressive with Coke. Still, at over $43, almost $43.50 a share, Coke looks overvalued. So it would not be a very good candidate for an undervalued dividend growth stock of the week article, which is why I don't think I've ever covered Coke in one of those articles over the last few years, because I haven't thought of it as being undervalued for quite a long time now, which is why it doesn't show up, because it's just not a good candidate. I have it as significantly overvalued. So that's basically where we're at, guys. I mean, I tried to, create a template for you readers and for you viewers to kind of follow along. And that way, when you read these articles from here on out, you can always reference this video and see, okay, well, I see where he's coming up with that. Okay, that's the 10-year growth rate for revenue and earnings per share, top line, bottom line. I see the dividend metrics. They line up with what David Fish has. Okay, I see the 5-year, net margin and return on equity. Okay, net margin. Okay, you take that, you take that. The balance sheet, okay, I see where he's coming up with that. Okay, so his opinion is that it's not terrible because of, these reasons, so on and so forth. So, and this is basically a video we're going to reference back. So when I create future videos, when I pick one of the undervalued dividend growth stock of the week articles to do a video on, this will always be a good reference point as a template. So you readers and you viewers can always look back on this video and kind of rewatch it and say, okay, well, these are where the numbers are coming from. And then when I do the future videos, I'll also reference all these numbers as well and say, okay, this is where I came up with this. This is where I came up with that. This is where I think the conclusion is. This is the reason why I came up with this, valuation, so on and so forth. So I hope you enjoyed the video. I look forward to continuing to write the undervalued dividend growth stock of the week articles for you readers. I hope I continue to provide a ton of value and perspective and actionable ideas for you. And I'm really looking forward to this new video series. I think it's going to be great. Very, very excited about it. And, if you have any questions, certainly shoot them over to the guys over at Daily Trade Alert. If you readers ever have questions about any of the articles, they usually get them to me. I do my best with getting back to you readers and everything else. I look forward to speaking with you again very soon. Bye-bye.